Good afternoon, everybody, and welcome to you all from me in London and from all of our market experts from across the EMEA region. My name is Peter Leyburn, and I'm Head of Enterprise Client Experience within the EMEA Occupier Services Division of Colliers, and I will be facilitating today's event. Please forgive my casual dress, but I do have the excuse of an injury, which means I can't take anything lighter than a shirt on my shoulder. The Colliers biannual EMEA market update should now be a regular fixture in your calendars. And given where we are with different markets in relation to the rollout of vaccinations and the overall recovery from COVID-19 pandemic, this will, I hope, be an interesting session for you all. We'll shortly be hearing from our experts in 15 of the most important markets in the region. And in addition to the market updates, we're also joined by Sam Addison, Head of Project Management, and Yanya Bugard, Head of Workplace Advisory within the Colliers EMEA Occupier Services Division. As companies begin to plan their return to the workplace, they're taking a fresh look at the physical aspects of what their office space should do, what it should look like, and what it should say about them as an organization. They're even more focused on the quality of space they will occupy. Sam and Yanya will discuss different approaches to the workplace of the future. They'll look at the new trends in relation to the pursuit of the ultimate green credentials, of smart buildings, of human-centric design and construction, and what they expect the trends to be over the next 3 to 5 years. So please make sure to stay with us to hear this session. But to begin with, let's hear from our market experts from across the region. And I'd like to go first of all to Amsterdam and hear what's happening in Netherlands. Caroline den Ouden. Caroline, can you tell us what's happening in Amsterdam?
Yeah, thank you, Peter, and good afternoon, everyone. Market dynamics in the Dutch office market are still far behind the dynamics of previous years. At the moment, the take-up volume over the last 6 months is about 30% lower than over the same period the year before. We see that this is even greater in the big cities. For example, the market dynamics in Amsterdam are 35% lower compared to the year before. One of the largest office transactions of the past 6 months was the lease of approximately 40,500 square meters of Just Eat Takeaway in Amsterdam Center. Parties still renting office space are tech companies, for instance, e-payment companies like Molly and Adyen. Banks and insurance companies in particular are pre-sorting to continue with less office space in the long term, resulting in more subletting at this moment. Most occupiers still have a wait-and-see policy, postponing relocation decisions. On the landlord side, we noticed that more landlords are looking for certainty, which ensures that more room for negotiation is created for occupiers. The office vacancy rate in Amsterdam is 7% and is rising. In the Netherlands in general, the vacancy rate is 7.2% and is decreasing. This is mainly due to redevelopment of offices into, for instance, residential space. Gross rent is still stable, but incentives are rising. At the moment, we are seeing for the first time in years that flex office operators are not expanding. As a result, the share of flex offices remains virtually the same as before COVID-19. Nevertheless, the expectation is that this market will continue to grow. The dynamics in the office market will not change much in the coming months. It is expected that the change will only take place after the summer, when it becomes clear what the effect of working from home is. Many companies are expected to adopt a hybrid way of working. Managing peak occupancy in the office will be the challenge, as well as estimating the right ratio between working from home and working in the office. It will take a few more months before the right balance will be found and the structural impact this will have on the office market. That's it from Amsterdam. Back to you, Peter.
Thank you very much, Caroline. Let's go to Romania and hear from George in Bucharest. George Didu.
Hello, everyone, and welcome from rainy Bucharest. Now, the good news is that when it comes to supply, Bucharest is still undersupplied for the office market, so we're expecting that to be compensated by major developers in the upcoming year. Although in 2020, about 25% less office projects came to the market, we're expecting that to be increased in 21 and 22. Total market activity was impacted as companies decided to freeze ongoing processes for obvious reasons, and the total take-up decreased by about a third. This, however, can be viewed as a positive sign since we were expecting the impact to be higher than just a third. Although the first trimester of 21 was below the first trimester of 2022, the market is becoming very active with multiple ongoing deals. One of the most notable ones was the 11,000 new deal, 11,000 square meters new deal by Wipro. ITC companies still rule the game with about 50% of transactions coming from this sector. A secondary market emerges, that of subleases. However, it does not pose a serious threat to seasoned developers just yet. We are seeing more flexibility from the landlords, not so much regarding headline rents, especially not in newer properties, in quality properties, but as far as incentives packages go, these have become more aggressive. Vacancy stands around 14%, generated, as I was saying, by older buildings specifically. Most companies, and this is an interesting turn of events, have started to pay more attention to the way they design and structure the workplace for the hybrid way of working, both from home and the office. Our completed survey showed that out of the 80 companies that we engaged with, the average showed that most companies and most employees would like to work from home about 2 days a week. Some companies are scaling back their space, usually 10 to 20%, but at the same time, they're investing in giving their employees an upgraded workplace experience. Near-term hiring intentions are the same or even above the last 10 years averages. And we're also pleasantly surprised by the fact that most of the sectors, business sector we are surveying, surpassed the 2019 turnover level. That's it from me. Back to you, Peter.
Thank you, George. Let's go to Hungary now and Budapest, and to hear from Miklos Exodi. Miklos.
Thank you, Peter. Good afternoon from Budapest. I'm Miklos. Hungary performed relatively well in the spring with low number of cases, but a lot of restrictions. At a second wave, number of cases were around 1,000 per day, but no hard restrictions were introduced during this time in the autumn. The situation changed during the third wave in the spring though. Number of cases were way above what we've seen before. Curfews, strict lockdowns were introduced, but this only took place in March and April as vaccination is progressing in a fast manner. Today, almost half of the population received at least the first dose, so life is slowly but surely getting back to normal. Last year, GDP drop reached more than 5%, which was followed by a fast recovery in Q1 2021, with almost 2% increase on a year-on-year basis. The forecasts are between 5 to 6% for this year. The unemployment rate dropped to 4%, which is already 0.5% decrease from September. Most occupiers who postponed their projects last year are coming back to the market again. It is a good sign that several new entries in the HSC sector are on the horizon. The latest new entries came mostly from the IT and HSC sector as well, like Nilfisk, Diligent, and Huawei, for example. It is also a promising sign that in Q1 leasing activity was very similar to the past years with a take-up of 75,000 square meter, although net absorption is still very low due to the high number of handovers. The share of renewals increased, but still we had two major relocations above 10,000 square meters during last year. One is British Telecom and the other one was Vodafone. Constructions are still going in line with the original schedules, mostly due to the high development pipeline. The vacancy already risen about 9%, which is 3.5% increase to last year, and we expect this trend to continue. In addition to that, 2% more sublease appeared on the market on top of that. Headlines are stable, but the incentives started to increase, and some of the landlords became open to offer 3-year leases to tenants. The occupiers are in the process currently rethinking their office spaces. We expect higher sharing ratios in the future, more collaborative areas, and flex office spaces. Most of these occupiers plan to get back to their offices around September. Thank you from Budapest. Back to Peter.
Thank you, Miklos. Let's now go to Denmark. Ulrik Rekker, tell us what's happening in Copenhagen.
Thank you, Peter, and good afternoon from Copenhagen. Looking back at the winter 2021 and the second long lockdown, which is now ceased, we can see that once again, Denmark was not as hard hit as other countries. After a GDP drop of 3.5% in 2020, the central bank now expects a growth of 1.4% for 2021. Unemployment remained stable at relatively low levels, hitting only 4.6%, and house prices grew by 4.3%. Despite COVID, several large deals were completed with tenants such as Genmab, Abacus Medicine, and Visma. Office vacancy in Copenhagen increased to 10% due to new stock becoming available. Rent levels and incentives remained largely unchanged due to the overall stable demand. Our current sentiment is positive, with vaccination progressing smoothly, Denmark will almost fully reopen already tomorrow, with very few restrictions remaining in place. Unemployment has been falling since March and is now back down to almost pre-COVID levels. Tenant demand for quality office space continues to be strong. There are currently several large projects of more than 10,000 square meters in technology, industrials, flex, and luxury goods in the market. Occupier trends and responses are increased desk sharing ratios across the board and fully implementation of activity-based working. A 20 to 30% working from home share is now the new normal, that having doubled during 2020. An increase of number of employers are now funding fully fledged workplaces at home. The outlook for the rest of 21 is positive. GDP expected to grow 1.4% and next year by 4.5%. Office vacancy, rents, and incentives in Copenhagen will remain stable. We saw upward adjusted guidance from major Danish firms across various key sectors such as transportation, pharmaceuticals, and finance. House prices are expected to increase by approximately 10% during 21. And that's all from Denmark. Back to you, Peter.
Thanks, Ulrik. We're now going to go to Paul Finucane to hear what's happening in the Republic of Ireland and the city of Dublin. Paul.
Thank you, Peter, and good afternoon, everyone. Dublin Q1 take-up reached only 4,000 square meters, the lowest quarterly figure on record, which was not surprising given the ongoing uncertainties wrought by Dublin's level 5 restrictions and continued home working. Construction remained closed and restrictions on movement led to further postponements of office tours and inspections. Of 13 deals concluded, only one exceeded 1,000 square meters. The city centre accounted for 70% of take-up, with 30% in the suburbs. However, the news is now much more encouraging. An increase in demand is clearly evident, and a number of much larger deals were reserved as Q2 began. The reserved space has now risen to 80,000 square meters, which is more than double that of the previous quarter. TikTok, Just Eat, BNP Paribas Bank, Accenture, 2K Games and Wix have all now reserved space, and we expect activity to continue to accelerate into the second half of the year as the vaccine rollout takes impact and the workforce returns to offices. Given construction sites were closed until April, the delivery pipeline remains unchanged, but critically 40% of stock under construction is already pre-let. Vacancy rates rose slightly in Q1 and now stand at 9.5% in the CBD and 10% overall. Quoting rents for new and pipeline grade A stock remain relatively unchanged across all office submarkets, with landlords more focused on offering improved rent-free packages in order to protect headline rents, which currently stand at €650 per square metre per annum in the CBD and €350 per square metre per annum in the suburbs. There are much better deals available for older stock, but one trend we have really seen accelerate this year is a flight to greener buildings. Green credentials have now become as important as location and public transport links when it comes to choosing a workplace, and we're beginning to see the rental gap widening between this grade A stock and the rest. Back to you, Peter.
Thank you, Paul. I'd now like to go to Germany and to Josephine Luper in Germany. Josephine is going to talk about several different markets, I think, across the region, across Germany. Josephine.
Exactly. Thank you, Peter, and good afternoon to all from Germany. The office leasing market remains in its waiting position so far, whereas the space take-up in the top 7 in the first quarter was around 660,000 square meters, which is 5% above the first quarter from 2020, but still 23% below the 10th year's average take-up. The vacancy rate is rising now to average moderate 3.8%. The prime rents are still stable, whereas average rents show little tendency to go down. Prime rents in Germany are lowest in Stuttgart and Cologne, where they are around €25 per square meter a month, and goes up to, for example, Munich 39 and Frankfurt €45 per square meter per month. In the pandemic-related economic and uncertainty, and in combination with the question about future requirements of office workplace concepts, still leads to reluctant behavior for new lease contracts, especially for bigger space searches above 7,000 square meters. The pipeline for new developments which will come to market this year, is around 1.6 million square meter, whereof 2/3 are already leased out. Still, there is a positive economic mood for the outlook this year, and this is based on the vaccination strategy in Germany, which gathered some momentum now and has now reached approximately 39% who had the first vaccination already. In addition, economic recovery can be foreseen from different economic institutions, which are forecasting a growth in GDP of 4% until the end of the year. Even with some delays, this will have a positive effect on office space take-up for 2021. That's it from Germany. Thank you to all, and back to Peter.
Thank you. Thank you very much, Josephine. Now we're going to go all the way down to South Africa and to hear from Mike Blair, who is going to tell us what's happening in Johannesburg. Mike.
Thank you, Peter. South Africa has just entered the third wave. The national office vacancy is reported at 13.3%, but there are certain nodes showing vacancies well above 25%. The bulk of the vacancies are seen in B and C grade properties, with landlords looking at new creative ways to repurpose and revive these assets, residential conversions being a popular consideration. Hugely discounted rental rates with generous landlord incentives seem to be creating some churn in the hard-hit office sector. In some key established office nodes, we are witnessing big business wanting to give back between 20 to 50% of their contractual lease space. This is not yet reflected in the vacancy forecast due to signed leases being in place, but will naturally fuel the sublet market, which is expected to grow exponentially. Actual occupancy rates of ongoing leases are not documented, but the impression is that major nodes are operating at below 50% footfall. Although work from home structures are city and company specific, we are forecasting that big business will maintain a 25 to 35% work from home arrangement and until at least 2023 and possibly beyond. Work from home structures in this region have their own set of challenges. The availability, quality, and stability of power and connectivity is of concern in many areas. Most of our time is being spent in the advisory sector, mainly focused on the give back of office space and right sizing of premises for new workplace requirements that have resulted from COVID. The total cost of occupation has become increasingly important in this region due to the above normal and ever increasing power costs that have been awarded to the state-owned power utility company. We anticipate that the office rentals will further worsen before the markets stabilize. We've had a very slow vaccine rollout, which is affecting business confidence and delaying decisions. Having said that, there definitely seems to be some optimism in the market, which we are hoping will translate into some positive economic activity. Thank you, and back to you, Peter.
Thank you, Mike. So we're going to come back to sort of where I'm sitting really, which is London and the UK. Henry Peter, tell us what's going on in London.
Thank you, Peter, and hello from London. 70% of the UK adult population have now received the first vaccination. And with the end of the second lockdown that began in November 20 now in sight, with the 21st of June, the date when all restrictions are due to come to an end, businesses can now start to plan for the future and encourage employees back to work. And we're seeing about 50% of employees now back in the office 2 to 3 days a week. And I mentioned in the last presentation that the release of occupier space will define the market change, and that's a continuing trend we're seeing. In the worst point of the great financial crash, 7 million square feet of tenant space was being marketed. We're predicting a potential for around 5.5 million square feet by the end of this quarter. And that's the highest level since 2011. Vacancy across London today is an average of about 8.3%, with some areas seeing vacancy rising to 11%. When we look back at previous cycles, when the vacancy reached 8%, we've seen significant downward pressure on rents, and we're starting to see that come through for grade A- space. We think there's probably 10 to 15% better incentive packages available now than in December. But demand is starting to pick up, which will be the key driver here. And as this space comes through, we're witnessing a tale of two markets, where high quality space will have interest as a lower cost alternative to flex space, while space with poorer old fashioned fit outs are more likely to stick. We've seen a number of recent transactions for high quality space, including lawyers, Latham and Watkins, who have taken a pre-let in the city of 240,000 square feet, TikTok,
for 86,000 square feet in the city fringe, and US clothing company PVH Corp have taken 50,000 square feet in White City. And finally, Waypoint have taken 34,000 square feet in Mayfair. So that concludes the London overview. Back to you, Peter.
Thank you very much, Henry, for that. I'm now going to go to our man in Madrid, Martin Galbete. Martin, tell us what's going on in Madrid.
Thank you, Peter. Good afternoon from Madrid. The state of alarm ended 2 weeks ago due to significant reduction of positive COVID cases in the whole of Spain. The result of this was lifting mobility restrictions and curfews. The current rate of vaccination gives cause for optimism, and the government estimates that 70% vaccination will have been achieved by September, allowing people to be in open spaces without the need for masks. During the first quarter of 2021, the Madrid office market has been characterized by low take-up of space, which has led to total levels of 65,000 square meters leased. These volumes are in line with the 3 preceding quarters and reflect the negative impact that COVID is having on economic activity in general and on the office market in particular. Companies are still under teleworking mode, and a general return to the office is not expected until after the summer. Companies are currently reconsidering how to use their spaces in the future, focusing on the new factors that are becoming increasingly important, such as sustainability, efficiency, remote working, job rotation, etc. The availability rate has increased as a result of the cancellation of space in the search for cost savings and space optimization by companies. The vacancy rate now stands at over 10%. The stock level remains stable at 17.5 million square meters as no new product has been added to the market. However, a total of 250,000 square meters of new product is expected to be delivered in the coming quarters. Flex office space remains stable. Regarding rents, we are beginning to observe slight decreases in all areas of influence. This is more intense in outskirts areas and lower in the CBD. Landlords are open to be more flexible regarding lease incentives, such as longer rent-free periods and cash contributions. The most active sectors in recent months have been public administrations and education. The most relevant transaction of the first quarter has been the lease to Justit of 7,200 square meters in Méndez Álvaro area at a rent of 23 euros per square meter month. That's all from Madrid. Back to you, Peter.
Great update. Thank you, Martin. Let's go to Russia and to Moscow. And I think it's going to be a fairly positive update here from Francois. Francois Nonnemak, and what's happening in Moscow?
Well, greetings from Moscow, Peter, and everybody. The majority of occupiers have now resumed a relatively normal occupation of their office space, and this may be certainly linked to the rollout of the numerous Russian vaccines. Despite a recent increase in COVID cases, we don't foresee any dramatic changes in the way offices are being used by corporate occupiers. Many companies have now adjusted their footprint and allow for more flexible work for their employees, but this isn't a general trend. Government and private sectors differ greatly in their approach. All prices have increased over the past months, and this creates a sense of optimism for the next part of 2021 in the Russian economy. There were several large deliveries of space in the first quarter of 2021, which mainly deferred space from 2020, lifting the stock of quality offices above 19 million square meters for the first time. Take-up was very similar to the amount of space delivered over the first quarter, and therefore vacancy remains stable at 8.5%. The majority of leasing activity was carried out by internet and online companies in Russia, such as Yandex leasing 5,000 square meters in Skolkovo, which is the Russian Silicon Valley, and Ozon taking 6,000 square meters during the first quarter in Moscow City. Now, enough, Ozon has started looking for its future headquarters and plans to acquire up to 220,000 square meters of office space by 2024. Needless to say that this is by no doubt one of the largest office projects in Europe for the coming years. We are also witnessing an interesting office construction boom for the next coming years, with many developers being forced to revisit their plans and develop offices instead of residential buildings. And despite this possible oversupply, demand is strong, and we don't think that this will increase vacancies substantially and produce great oversupply in the market. So we're definitely very optimistic for the future. Thank you very much, Peter. Back to you.
Thank you, Francois. We're going to go to France now and to Paris. Gauthier Weige, tell us what's happening in Paris.
Good afternoon from Paris. Early 21 in France offered a glimpse of recovery, also some questions regarding the scale of the durability of the upturn in the office real estate market. As the only hope for a way out of the crisis, vaccination may be gaining pace in France, but a third lockdown has shuffled the deck, obliterating any certainty and undermining forecasts. Q1 reflected this uncertain state with an office take-up decrease of 30% compared with Q1 20. As a reminder, 2020 has shown a decrease of the office take-up of 45% compared with the previous year. One positive sign was the good activity in the large space segments of Q1 21 with 13 transactions versus 10 in Q1 20. But that was on smaller surfaces between 5 and 10,000 square meters, such as the emblematic luxury French brand Chanel, who leased 6,500 square meters in Paris, high-end suburb at the prime rents. Unless the business districts of La Défense, who suffered from the crisis and due to a huge increase in supply coming in the next 2 years, headline rents have resisted in Paris region and CBD, where landlords provide more incentives around 15 to 25% discounts. Paris CBD prime rents remain unchanged at 900 per square meter. The reduction in transactional activity has had a direct impact on immediate supply, which rose to 3.79 million square meters by the end of Q1 21. This reflects new unleased building completion as well as releases of space, which have taken the vacancy rate for the Greater Paris region to 6.9%, compared with 5.3% last year. On the top of that, we estimate the subleasing market representing around 6% of the supply. This position is a sign of the market transformation that is underway and is indicative of a post-crisis renewal for offices real estate, more flexible, more hybrid, more efficient, and less carbon intensive. Thank you. That's all for Paris. Back to you, Peter.
Thank you very much. 4 more markets to go. Let's go to Czech Republic and Prague and hear from Petr Zalski. Petr.
Thank you, Peter. The Prague office market consists of 3.69 million square meters and the vacancy level stands at 7.6%. Another approximately 2% of the stock are being offered for sublease. For comparison, at the end of 2019, the vacancy was 5.1%. So we do not see significant change and can consider the market to be healthily balanced. The gross office take-up for the first quarter of 2021 was 30% stronger in comparison to the first quarter of previous year and amounted to 90,000 square meters. Out of that, renegotiations were 46% and pre-leasing activity accounted for 11%. The most active sectors were pharmaceutical, IT, and professional services. The largest deal was renegotiation of Novartis with 14,000 square meters. Considering the high gross take-up in years 2015 and 2016, which were about 450,000 square meters, and only 330,000 square meters recorded in 2020, we believe the positive trend will continue within this year, and the companies will be forced not to delay the decision about their office anymore. Rental levels remain stable, but as for the past 5 quarters, we witness more generous incentives being provided to tenants. The expected level of supply for the remainder of 2021 is just over 65,000 square meters, and out of that, more than 55% is already pre-leased. Very significant, similar will be 2022, where we expect to be delivered only 78,000 square meters, which are under construction. For comparison, the average supply for past 10 years is around 135,000 square meters. Furthermore, there are other projects in pipeline with construction permit in place, but those awaiting to secure sufficient pre-lease to proceed with the construction. All from Prague, back to you, Peter.
Thank you very much, Petr. We're now going to go to the Middle East. We're actually going to cover 2 markets in the Middle East. We're going to cover Dubai and Riyadh. Ben Scott. Ben.
Hi, good afternoon, everybody. 2021 in the Middle East has provided a dynamic and changing occupier environment, particularly with regards to key changes in legislation announced over the last few months. From the 1st of June, new regulations in Dubai will allow 100% foreign ownership of companies outside of the traditional free zones, which has the potential to widen the opportunities for tenants, with full details of the legislation expected imminently. In regards to the office market, we've seen a focus on renewal and reconfiguration of existing premises rather than relocations. Tenants are increasingly seeking greater flexibility on terms, as well as tenant incentives such as rent-free, especially as landlords in the region are traditionally resistant to fit-out contributions. Prices for premium and grade A have reduced by around 10% over the last year, with a vacancy rate of 25%, compared to 35 to 40% for lower quality premises. In Saudi Arabia, the government has recently issued a directive that from 2024, any international company wishing to provide services to a government entity must have their regional headquarters in the kingdom. With governmental spend driving over 80% of business in the Middle East's largest economy, many companies have begun exploring the logistics of this, with PepsiCo, Deloitte, and Schlumberger among 24 international firms committed to the plan during its launch in February. Riyadh is continuing its rapid transformation and modernization in line with the Kingdom's 2030 plan, with a drive towards increasing the supply of prime stock to an undersupplied segment of the market. With premium and grade A occupancy of around 95%, Riyadh rents have remained stable over the last 18 months, with little change in tenant incentives. The completion of the King Abdullah Financial District in several phases over the coming years will add 1 million square meters of prime commercial space, doubling the size of the market, and we would expect this to have a major impact on prices across the city. With the lifting of the regional embargo on Qatar, 2021 will prove to be an interesting year for regional occupiers. Back to you, Peter.
Thank you, Ben. Let's go to Israel. We're going to hear from Sarit Ishakov, who is in Tel Aviv. Sarit.
Hi, everyone. 63% of the entire population in Israel is vaccinated, which results in almost a full return to normality in every life aspect. Entry to the country still continues to be limited, which affects mostly international companies from traveling to Israel to site inspections or negotiations. Most of the Israeli and international companies allow their employees to return back to the office. The wishful thinking is a return of 70% of the employees, but the actual reality reflects a return of 62% due to high traffic and commute time, and of course, the flexibility to work from home. In the first quarter of 2021, investments of $5.37 billion were recorded to the high-tech sector in Israel, an increase of 89% compared to the same quarter last year. The investment reflects the high recruitment rate of employees, and of course, the vice versa of the increase in demand for office space. Most of the demand is recorded in the Tel Aviv CBD area, where we experience a big struggle with current supply. Currently, the vacancy rate for office space over 700 square meters is less than 30% in the CBD area, where just 12 minutes away, you may find greater solutions. Latest transactions in Tel Aviv CBD area are Rapid, an Israeli fintech company taking 27,000 square meters, Takeaway expanding by 4,500 square meters, and Wix expanding by 3,000 square meters. Happily, the demand of the office space in Tel Aviv is high, although the bitter news is that the supply is very low until 2024 and very limited for new construction. This may push companies to look at solutions outside of Tel Aviv or in the second tier from the CBD area, or even maybe implement new hybrid solutions. Interestingly, following the hybrid model, residential real estate developers are planning projects with rooms and work areas, including co-working areas in their buildings. That's all from Tel Aviv. Thank you. Back to you, Peter.
Thank you, Sarit. Last but not least, we're going to go to Warsaw, Poland, and hear from Bianca Kuczynska. Bianca.
Thank you, Peter. There's a little bit more optimism in Warsaw now. Santander's forecast for Poland's GDP for 21 was increased by 4.6%. Inflation is growing. Now it's 4.3, and it's expected to accelerate over the next months. The labor market generally remains quite resilient, with unemployment rate of 6.4, with surprisingly strong increase in wages. New supply of office space is on the rise. In Q1, developers have delivered more space than they did over the entire 2019, but over half of this space is already leased. This year, we expect a record new supply since 2016, but it will be gradually decreasing over the next years, with another minimum expected in 2024. Vacancy rate increased by almost 4 percentage points comparing to pre-pandemic time, and amounts to a healthy 11.4%. Since we are still mostly working remotely, the amount of space offered for sublet is growing dynamically. We expect vacancies and subleases to grow gradually over 21, but stabilize in 22. Pressure on rents is reflected rather in increased incentives than decreased headline rents. The completion dates of some new projects have been delayed, mostly slightly, but very few constructions were cancelled. Demand in 2020 dropped by 1/3 in comparison to 2019, but in Q1, the drop was only 20% in comparison to Q1 2020. The renegotiations share in overall demand already came back to pre-pandemic levels. Most active sectors were finance and banking, public sector, and manufacturing, with biggest transactions of pre-let of Public Transport Authority, renegotiations of Credit Suisse, and renewal of Royal Bank of Scotland, all in range between 5,000 and 7,500 square meters. That's it from Warsaw. Back to you, Peter.
So thank you to all of our market experts. If any of you, the audience, have any questions for any of our experts, please put them in the chat. We will see how much time we have at the end. If we haven't got time, we'll come back to you directly. But let's move on a little. You heard some of our experts there talking about the change in the way that occupiers are laying out their space, what they require in terms of workplace and what they require in terms of the physical aspects of the buildings. So let's learn a little bit more about what the buildings should be doing for us in the new world we're moving into. Let's first hear from Janiat Bugard. As I mentioned in my initial introduction, Janiat is Head of Workplace Advisory within Colliers. Janiat.
Yeah, many thanks, Peter. And thanks everyone for joining today. I would like to share some high-level insights in what's actually happening now. So how are organizations strategizing their workplace for the future? So if we go to the next page, what we see is that during the pandemic, we identify sort of 3 different stages. And as Colliers, we are collecting a lot of data during each of those stages. We started in March 2020, when the first countries were going in lockdown, to measure the experiences with remote working, but also the future role of the office and how people see the future role of the office. And we developed a report called Exploring the Post-COVID Workplace. It was really about exploring and collecting the first data. What we see now is that we're getting in a stage that we call like developing the post-COVID workplace. So we see a lot of organizations starting developing the future workplaces now. Today, we would like to focus on that and sharing insights into sort of the emerging and the common themes that we are seeing. In the next phase, I think that there's going to be a really interesting period when people start going back to the office, which is already happening in certain countries, as we just heard, to collect data and to collect experiences, because no one exactly knows how the future will look like, and no one exactly knows what the experiences will be when people start going back. So we will collect a lot of data there again and bring out a new report in Q4 2021 with that data. So if we move to the next one, so what are the approaches that we are seeing in the market, and what are approaches that different organizations are taking? And we identify sort of 3 approaches. So the first one, strategize and transform before people start coming back to the office. So we see organizations, and we're working with organizations where we are currently transforming, resizing, and redeveloping offices in order to have a new experience for people when people come back to the office. Potential advantage of that is that there's a complete new experience when people come back, and that the risk that people fall back in their old behaviors and habits is reduced. The second approach that we're seeing is pilot, experiment, and transform. So we're working with many organizations to develop pilot areas in the office. So refurbishing a floor or refurbishing a part of the office, creating more collaborative spaces for people to use when they come back to the office, with the main reason to collect data and to measure the experiences and to use that data to further develop strategies in the future. The last approach that we're seeing, we call like hold, collect, and learn. So we also see organizations who are not changing anything yet in the workplace, but want people to come back to the old environment and when people are back, measuring the experiences. So we're working with organizations at the moment to develop research methodologies to collect all the relevant data when people start coming back to the office. So those are the three approaches that we're seeing. Then when we move on, so what I would like to share today is insights in the data that we are collecting via our Workplace Expert tool. We launched this tool end of last year in the pandemic, and it's used by many organizations to get first high-level insights in what type of workplace and what size of workplace best suits to the business. Over 4,000 professionals used the tool and filled in their business characteristics, but also their view on remote working. There's a lot of data. We will bring out a new report the end of this week, which we will share with everyone after the webinar. But I would just want to show a snapshot of some of the key insights that we're seeing from the tool. And the first topic has to do with the goals that organizations identify for their future office and the future workplace to impact on. So I think the first question should be, what do we want to achieve with our future workplace? That's also why each workplace for every organization is different, because the goals of organizations are different. What we're seeing in our data is that flexibility is the #1 goal identified by organizations, followed by collaboration, but collaboration across teams, but also collaboration between teams, and productivity. So these are the key drivers that we see behind workplace transformations at the moment. Then when we look at remote working and the view that organizations have on remote working in a post-pandemic world, what we see on the left side is that on average, organizations strategize for about 56% working from the office. So that's about 2.8 days working from the office and 2.2 days working outside of the office. I think what's remarkable is that this data is really consistent across many different researches. So in a lot of researches, almost every research, it says it's about 2 to 3 days working remotely, 2 to 3 days working from the office. And also when we look on the right side to how this data is changing over time, it's really consistent over time. So we don't see the data changing a lot during the pandemic. There are also differences between industries identified, and especially the public sector and transport and logistic industry strategize their future workplace requirement based on a higher presence in the office, even above 68% working from the office. When we look at the other extremes, it's retail, professional services, energy, utilities, and automotive sectors who strategize for less presence in the office, below 50%. We also identified a lot of differences between regions and countries, but that data can be found in the report that we will launch. Then moving on to the actual changes that are happening now in the workplace. So if we look at organizations that we are working with now and the changes that we are making now in the workplace, I want to highlight a couple of sort of emerging and common themes. If we look at sort of a typical pre-COVID workplace, of course, there were a lot of different types of offices pre-COVID as well. And I think a lot of organizations were already on the journey towards more flexibility and more activity-based working. But just to give an insight in the key changes that we're seeing now, that pre-COVID, we saw that many organizations and many offices facilitated individual work more in the open space behind desks and collaborative activities more in collaborative settings, informal or more meeting rooms. A lot of organizations had fixed team areas that sort of served as a home base for teams. Activity-based working, as mentioned earlier as well, so having specific settings for specific activities. There was a risk to that as well, because if activities change over time, it requires potential refurbishments to ensure that the workplace keeps aligned with the needs from the business. And we saw that in many workplaces, there was like a personalized experience through areas for teams, or through dedicated desks that could be personalized. Then if we move now to the post-COVID workplace and the changes that we see happening in the office now, we see sort of the way the work settings are being used changing. So we see individual work being performed more from home or specifically allocated areas in the office, like library spaces or smaller enclosed rooms. So we see an increase in those type of settings in the office. But in most of the projects, we still see that individual work will be facilitated from the office as well. So it definitely moves more towards collaboration, but most organizations still want to facilitate individual work as well for people that cannot work productive from home or do not want to work from home a significant amount of their time. Then we see that the team areas become more flexible, so they could change over time depending on occupancy levels or the number of people that are in the office. But most organizations still create team areas that serve as a home base for teams. So the location in the building could change over time. Then we see that the workplace becomes much more multifunctional. So instead of having different settings for collaboration, for individual work, for socializing, we see that spaces become more multifunctional and can be used for multiple activities. And finally, the personalized experience is still there, but more on team level instead of individual level. So enabling teams to visualize their identity instead of individuals. Then when we look further into the future, I think really interesting to see what the key changes are that we expect, but also how technology potentially plays a critical role in that. And I think the key thing is how can we integrate more the physical world with the virtual world. And there's a lot of new technology coming on the market and organizations doing pilots with different technologies to integrate the virtual and the physical world more in order to have a more inclusive experience for people, for example, who are not in the office and people who are in the office. So you can think about applying augmented reality in the space or a virtual reality in the space. And the technology is there. The question is, how will it be applied and how can it be applied to the space? So there's going to be a really interesting period where I think it will be a period of trial and error where the different technologies will be tested to get closer to the in-person experience without being together in person. A final thing on this and on the future workplace is that we expect the workplace by applying these technologies to becoming even more adaptable and multifunctional. So by using augmented reality and virtual reality to change and sort of instantly change the experiences in the space would help organizations completely changing the look and feel and the experience in the office with just a press on a button instead of refurbishment or redesigning the space. That's it from my side. I'll hand it over to Sam to focus more and dive deeper into the human-centric design, but also to focus more on sustainability.
Great, thanks, Jan-Jaap. So whilst Jan-Jaap has been discussing the post-COVID workplace, I'm going to talk about the impact that this and other macro trends are having on building quality. In other words, how the technical specification of office buildings is evolving to meet occupier needs. Next slide, please. And we can see three mega trends impacting building design and construction: green buildings, smart buildings, and human-centric design and construction. So first of all, let's talk about green buildings and what's driving that change. 40% of the world's carbon emissions come from the built environment, and yet only 1% of our global stock operates at carbon net zero. And with an annual stock refurbishment rate of only 2%, we've got a huge retrofit program to be rolled out. You'll all have heard about the Paris Agreement. We now have 197 countries signed up. And you can see on the right there's a graph that shows how different countries have, at different stages, enshrined in law, incorporated into legislation and into policy. So this change is happening. The UN Sustainable Development Goals, they're a blueprint to achieve a better and more sustainable future for all. And they recognise that the world will operate at carbon net zero. We have a choice about how we get there. It'll either be driven by natural events and disasters, or it'll be a managed transition through businesses and organisations to a low carbon future. Carbon legislation and policy is driving change. We can see in the UK, for instance, the EPCs, we have a change coming up, for instance, in 2023, where landlords will not be able to let properties with a rating of F and G. So that we'll see stranded assets. And then lastly, social tipping points. We've seen in the last couple of years a huge change in the expectations around electric vehicles and also the uptake in renewable energy. So all of this is driving change in our built environment. Next slide. This is a great image from the World Green Building Council showing how green offices can provide the foundations towards meeting the UN's Sustainable Development Goals. I'm just going to mention on one item on the right-hand side around the circular principles. I think this is going to be a key sub-trend to green buildings, where we're going to see innovation and creativity around reducing the use of virgin materials and looking to recycle materials such as carpet and plasterboard. So I think that's going to be a key trend. Next slide. And actually, what is a green building? And you can see here a definition, again, taken from the World Green Building Council. And I've highlighted a particular point: efficient use of energy, water and other resources. Renewable energy is important, but first of all, we need to make sure that our buildings are efficient. So that's installation and the type of technical systems installed and how they're managed. Pollution and waste reduction measures, good indoor environmental air quality, the use of non-toxic materials and consideration of the environment in all aspects. and the quality of life of occupants, and a design that enables adaptation to a changing environment. Next slide. And what are the risks and opportunities? Because again, if we're talking about real estate from different perspectives, from owners and from occupiers, well, the opportunities: lower operating costs, increased well-being for the occupants, increased resilience, so taking into account the climate risks, and employee engagement enhanced. The downside, if we don't embrace the change to green buildings, and you heard Paul talk earlier about the change in the Irish market, we'll have stranded assets, we'll have difficult locations, and we're going to have the climate physical risks and the impact that has on the occupants of buildings and energy and efficiency. I'm just going to call out there an example on the right. It's an image actually from a project delivered by Colliers in the UK. And I mentioned on the previous slide about some of the approaches in green building, and there is a challenge around occupants, comfort and energy efficiency. This building actually used a mixed mode form of ventilation and cooling, so using ground source heating and cooling and chimney stacks for ventilation. So a great example of how you can get a mixture of those and successfully delivered. And supporting green buildings and agile working that Jan Jaap was talking about are smart buildings. And these are already here, very much the Internet of Things, and we're seeing an increase in the uptake of smart systems. And smart buildings can be described as a super system of interconnected building subsystems. So they monitor various building characteristics, they analyze data, and they generate insights of usage patterns. And you can see there a quote from some recent research, and it shows that actually, if it's an integrated system throughout the whole building, we can actually achieve savings, and that's across energy usage of up to 35%. So it's significant. And finally, the third mega trend that I want to talk about is human-centric design. And again, this links with green buildings and can be supported by the use of smart building technology. And it's also referred to as well-being. And you can see here some key points. So indoor air quality, I think it's staggering actually, but the productivity improvements of 8 to 11% impacted by the quality of indoor air. Thermal comfort, not quite the same impact, but still really important. And I think the really interesting thing is here, it's about personal control. So again, if you look at that overlay between green building and smart technology, you start seeing how that drives improved well-being. Lighting and views of nature. And I think we've known for some years about the impact of being close to windows, but actually research now shows it's not just about being near windows, it's actually about the view through the window and looking at the impact that has on people's well-being and productivity. Noise and acoustics, again, very much linked with what Jan Jaap was saying and the challenge of post-COVID working, where we're going to have collaboration and folks working, because actually noise is incredibly disruptive, or can be. So that's going to be really important in workplace and offices moving forward. And then interior layout, similarly, just making sure we've got the right balance. But then again, if you take a step back and look at the whole building, making sure that our real estate is flexible so that as workplace evolves, that we can actually change the configuration and the ratio of the different types. And finally, active design and exercise. We know that we need to be active. It's good for all of us. And you can see an image on the right here. This is from the planned Google headquarters in London. The current building actually already has some great garden terraces, but we've seen that as an ongoing trend across Europe of great outdoor space that our people, that are occupants of buildings, can use and improve their well-being. Next slide. So these are the mega trends. So green buildings, smart buildings, and a human-centered design. And finally, I'm just going to finish off with a bit of research from Colliers, building surveyors and project managers. So this is a snapshot taken today. So actually, when we're delivering due diligence surveys for our occupier clients today, these are the key issues that we're seeing. And you can see some of the mega trends that I've already spoken about are there, but there may be sort of fourth or fifth, but we expect over the next 3 to 5 years, these are going to be huge issues for us to consider in our design, construction and occupancy of our real estate. Back to you, Peter.
Thank you very much indeed. Now we've got a few minutes left at the end for some questions. So if you have any burning questions, please put them in the chat. I have a couple of questions here, which I'm going to ask. So if there's anything else you want to ask now, get typing quickly. A question for you, Jan Jaap, that has come in here. If people are going to work 50% remotely, does that mean we can reduce space by the same amount?
Yeah, it's a good question. Not necessarily. I think it's really important to look at peak occupancy as well, and how you're going to manage peak occupancy. So we see some organizations managing it more top down, so having like clear schedules, for example, in place for people to come in, or having a certain maximum occupancy on certain days. Other organizations leaving it more to individuals or to teams. When you do that, it's likely that a lot of people will come on the same days. So for example, working remotely on Fridays, coming to the office on Thursdays, which leads to certain peaks. And I think from a business perspective, it is important to consider how can you manage that, but also how can you bring different teams together on certain moments. So it's different for each organization, but there is definitely sort of buffer space required in order to be able to accommodate those peaks in occupancy.
Okay, I've got another question for you, Janip, as well. Is the data collected during the pandemic still representative, or do we expect it to change as we return to the workplace?
Yeah, I think that's a really good point. It's really important to keep measuring and monitoring over the next months or maybe even years, because no one exactly knows how it will turn out. I think a lot of data is collected during the pandemic, a period that's hopefully not fully representative for the future. So the data might change, but until now we see that the data is quite consistent and does not change so much over time. But it is critical to keep measuring and monitoring and to be on top of that. So yeah, I think it is critical to measure, and it could change over time. But we'll find out in the next period.
Okay, good. Sam, I've got a question, I think, for you here. And I've got to read this. What is the source of the stat that 1% of buildings are carbon net zero? And does that mean that individual assets are net zero, or is there an element of carbon offset involved in establishing that figure?
Yeah, so I got that statistic from the World Green Building Council, but it doesn't include offsets. So that's buildings at net zero and could be operated at that level. So you could look at other buildings, and if there was offsets, that would be taken into account. So that's 1% designed and able to be operated at net zero.
Okay. And I've got one question for our market experts here, for Martin in Madrid. We have a question here which says, is the development of the Barcelona submarket similar to what you described for Madrid? Are you able to answer that, Martin?
I will say it's not. I mean, the Barcelona market during the last quarter, the first quarter of the year, has developed another kind of I would say of environment. So the stock have been remains at the same level. There has been more take-up than in Madrid. Actually, it has been more take-up than during the previous quarters. In Barcelona, in the first quarter of the year, 75,000 square meters have been leased. During the last quarter of the previous year, only 44,000 square meters. So that's an increase in demand during the past quarter. The availability has increased as well than in Madrid, and the rents remains stable at the same values. Actually, with the same in line with Madrid, in terms of that the landlords are willing and are more flexible with the additional incentives.
Yeah. Sorry, no, I was just going to say that we just hit bang on the hour. And I think if there's more detail on that question, Martin, we can come back by email. And I think there are a couple of other questions as well which have come through, which if we haven't answered your question now, we will come back to you directly. So we've hit the hour. So it just remains for me and for everybody else on the call from Colliers just to say thank you for listening to us. And we look forward to speaking to you all again in 6 months or less. But certainly the next presentation will be in 6 months' time. Look forward to speaking to you then. Bye-bye.